Okay, in what follows, we will be going over the free cash flow model, like a very simplified version of a free cash flow model. But anyone interested to value a company using free cash flow method, this is the starting point. For this course here, this is an introductory course in corporate finance, so we won't go in too much detail in how to make the forecasts. But we're going to go over the basic details, like the foundations, the building blocks of the discounted cash flow model, the DCF, how we call it. So the full value of an enterprise should be given by what? Present value of cash coming in minus present value of cash going out. Right? What is cash coming in? What is cash going out? So how do we compute each of them? How do we compute cash coming in? How do we compute cash going out? For cash coming in, we look at the income statement. So what do we have on the income statement? Sales. So this is very simplified. So we have sales, cost of goods sold, depreciation. There's no fixed costs. You could have had like an extra line of selling and general expenses. We don't have that. No extraordinary expenses here. Everything is basics. So sales minus variable cost or cost of goods sold, doesn't really matter here. Minus depreciation gives earnings before interest and taxes. We subtract interest, taxable income, times taxes of 200, 40% of 500, that's 200. So that gives us a net income of 300. Sales is an entry of cash. Cost of goods sold and taxes are amounts of cash leaving the firm. Depreciation is an accounting value, so the cash is not leaving the firm this year. Depreciation is the variable costs, okay, associated to using equipment that has been purchased a long time ago. So the actual expense to buy the equipment has been made a long time ago. But if we say we bought an equipment that was costing $1,200 and we plan on using it for 10 years, so we can amortize the $1,200 over 10 years. So we can subtract from the income statement $120 per year for 10 years. So that would be the cost, the accounting cost associated to the equipment we use for the firm to produce the sales. But it is not a cash expense. And the interest expense will be taken care of in the discount rate we use to discount cash flows. So the cost of interest will be incorporated into the weighted average cost of capital. So we don't consider it as cash leaving the firm here. So a conservative measure of net cash coming in would be the following. So earnings before interest and taxes times 1 minus the tax rate. So as if we were applying the tax rate directly on earnings before interest. So here we abstract from the fact that the interest expense is tax deductible. We will take care of that the way we introduce the cost of interest in the weighted average cost of capital, as we will see later. But here take earnings before interest and taxes, so 580. We apply 1 minus 40%, so that's 60%, plus the depreciation accounting expense. So cash coming in could be estimated as 468 in this specific example. So this would be our net operating profit after tax. That would be the net. Now that would be the net operating after tax cash flow, the NOPAT, N-O-P-A-T. How do we compute cash going out? Cash goes out when the firm purchases assets. So cash goes out by, so to determine how cash goes out except for the cost of goods sold and taxes paid, we have to look at the cash that's being used to purchase assets. So on the balance sheet, we have current assets and current liabilities. So the current assets is the sum of all short-term assets. So assets that have an expected life of 1 year or less. And current liabilities is the sum of all current liabilities that have an expected life, a maturity of 1 year or less. We have this for 2001 and 2002, for year 1 and year 2. And we have long-term assets. Okay, if you look at long-term assets, I'll go over some details here, but this is not extremely important for this course. But if you want to understand really well the basics of discounted cash flow, you may want to pay attention here. So we have long-term assets. So 2,200, this is what the firm has paid over time to buy assets, to buy equipment, to buy machinery. From this, we subtract accumulated depreciation. Okay, so accumulated depreciation is the sum of all the depreciation expenses that appeared on the income statement from the time the firm was created. So this gives us net fixed assets of $1,000. So we have that for year 1 and for year 2. Okay, so here the most recent year appear on the left. Okay, just a note. The difference in accumulated depreciation has to be consistent with what appears on the income statement. So in year 2, the depreciation expense was 120. So we had accumulated depreciation of 1,080 on year 1. 1,080 plus 120 is equal to 1,200. We will be using this equality. It has to be respected. We will be using this identity later on in our calculations. Cash leaves the firm when the firm purchases assets. So on the firm's balance sheet, we see short-term assets and long-term assets. So if we take current assets and we subtract current liabilities, it gives us a measure that we call net working capital. So net working capital, NWC, is a measure of short-term assets. So in year 1, the firm had 440 in net working capital, and it had 580 in net working capital at time 2. So the money that has been spent on short-term assets, because some of them have been purchased by increasing some amount of debt, some amount of short-term debt, is the change in net working capital. So additions to net working capital from 1 year to the other requires some amount of cash. In this case, the firm has spent $140 to increase its short-term assets. So short-term assets went from 440 to 580. So that's an expense. That's a cash expense, a cash outflow of $140. Okay, so note if we had only used the current assets. So the current assets went up by 120. But current liabilities went up by $20. So the total amount of cash spent on current asset is not 160, but it's 140, because we take that 160 and we subtract the $20 increase in short-term borrowing. And that's a cash outflow. So 140 here is an amount of cash leaving the firm. Another amount of cash leaving the firm is the cash that's being used to buy long-term assets. So long-term assets is, so the increase in long-term assets gives us the exact amount of cash that has been spent to buy new assets. So if we take long-term assets in year 1, we have 1,980. and in year 2 we have 2,200 in long-term assets. This means during these 2 years, from time 1 to time 2, the firm has spent $220 in long-term assets. Correct? Okay, note that we can obtain this value differently. Okay, if we take net fixed assets, so the additions to long-term assets is equal to 220. This number here, 220, that's equal to additions to net fixed assets plus depreciation. Okay, the change in net fixed assets, what is it? It's 1,000 minus 900, that's 100. If we add depreciation to this number, it gives us 220. So additions to long-term assets, so capital expenditures, is equal to additions to net fixed assets, so assets after depreciation, plus depreciation. So the free cash flow to the firm, the free cash flow of a firm in a given year is equal to the net operating after-tax cash flow. So earnings before interest and taxes times 1 minus the tax rate plus depreciation. This is the cash flow from its operations. Minus additions to net working capital, minus money spent to purchase short-term assets, minus capital expenditures, CapEx, money spent to buy long-term assets. Now, since the change in long-term assets is equal to the change in net fixed assets plus depreciation, we can rewrite free cash flow is equal to earnings before interest and taxes times 1 minus the tax rate minus additions to net working capital minus addition to net fixed assets. So addition to net fixed assets in the textbook we are using here is referred to as net investment. Okay, so earnings, so EBIT times 1 minus the tax rate minus additions to net working capital minus net investment. Good. So free cash flow. So what is the free cash flow of this company XYZ in 2000X2? So EBIT 580 times 1 minus the tax rate times 1 minus 40% plus depreciation plus 120 minus change additions to net working capital minus 140 minus money spent to buy long-term assets minus 220, that's 108. This is free cash flow. We can compute free cash flow using net fixed assets and abstracting from depreciation because it's included in the calculation of net fixed assets. So earnings before interest and taxes times 1 minus the tax rate minus additions to net working capital, which is 140, minus net investment or additions to net fixed assets, which is 100, and that gives us the same number, the same value for free cash flow. So if we can forecast the company's balance sheet and income statement forever, we can compute a sequence of free cash flow for this company forever into perpetuity. And discounting the free cash flow for this company forever that are expected into infinity gives us enterprise value. So enterprise value is the present value of the company's free cash flow forever. So we have calculated the free cash flow before expensing debt, before the debt repayment. So the discount rate we use to discount the future free cash flows is called the weighted average cost of capital. So the weighted average cost of capital is the average cost of capital for this company. So the average of the cost of debt and the cost of equity. Okay, and here's how we take into account the tax deductibility of debt. here's how we take into account the fact that debt is paid before tax is calculated on the company's income. So it's by, instead of using the cost of debt, 8%, we use 40% of 8%. Okay, so 1 minus the tax rate times the cost of the actual interest rate paid on debt. So RW is the weighted average cost of capital. Okay, so we have the proportion of debt used to finance the firm's assets and the proportion of equity used to finance the firm's asset. So we find these proportions. So this would be explained in more details in a more advanced course. But this is taken by taking the value of the firm's debt compared to the value of the firm's equity, which is the stock price times the number of shares outstanding. The sum of these two weights has to be equal to 1, which is why we call that a weighted average. So it's not, the weighted average cost of capital is the weighted average of cost of debt and cost of equity. The cost of debt here is the interest rate paid on debt. If debt was issued today, what rate would have to be offered by the company so that investors buy the debt? So that's RD. Now debt is subtracted from earnings before interest and taxes before taxes are paid. So debt is tax deductible. So we don't use RD directly in the cost of capital, but we use RD times 1 minus the tax rate. So after tax RD. And RE is the cost of equity financing. So the enterprise value is given by the discounted value of all its future free cash flow into perpetuity. So if we assume that at some point in time free cash flow would grow at a constant rate GP, so we can simplify the equation, okay, by expressing all the free cash flows at time 6 and after as a value of the firm as of time 5. So taking all the free cash flows from time 6 and after gives us something we call the terminal value. So the terminal value is the value of the firm as of time 5 if the firm were to be sold at that time. So it's the same thing as P5 for the stock. So here FCF1, FCF2, FCF3, FCF4 and FCF5 is equivalent to D1, D2, D3, D4 and D5 in the case of a stock. Okay, and TV5 terminal value at time 5 is the same as P5 in the case of a stock. So terminal value at time 5 would be the value that could be obtained for the entire company if the entire company was sold at time 5 after the free cash flow at time 5 has been distributed to shareholders and equity holders. Okay, so the terminal value at time 5, what is it? It's the free cash flow at time 6 divided by, it's a perpetuity. Okay, so the terminal value at time 5 is a perpetuity of a sequence of free cash flows that grow at a constant rate. The next free cash flow is free cash flow at time 6. So the present value of this growing perpetuity is the next free cash flow divided by the discount rate minus the growth rate into perpetuity. And the free cash flow at time 6 is 1 plus this perpetual this growth rate into perpetuity times the free cash flow at time 5. Good. So that gives us 5 numbers. Okay, so free cash flow at time 1, free cash flow at time 2, free cash flow at time 3, free cash flow at time 4, free cash flow at time 5 plus terminal value at time 5. So we discount all these 5 values over the appropriate number of years at the weighted average cost of capital. So free cash flow is a cash flow that belongs, a fraction of it belongs to debt holders, a fraction of it belongs to shareholders, so it has to be discounted at the weighted average cost of capital. So FCF1 discounted over 1 year, FCF2 discounted over 2 years, FCF3 discounted over 2 years, and so on. That gives us enterprise value V0. Now, the correct price for this company is, so you take enterprise value. Okay, you take enterprise value, you subtract debt, because here we are looking for the appropriate stock price. So we subtract the amount of debt which belongs to debt holders. We add cash, because when we calculated free cash flow in each year, we subtracted the additions to net working capital, and cash is part of net working capital. But if we acquire a company and there's cash in the company, I mean, it's like we're paying for cash is like not paying. So we add cash back. So V minus debt plus cash gives us the correct value of total equity. If we divide the correct value of total equity by the number of shares outstanding, that gives us the correct stock price for this company. Okay, and this is the free cash flow valuation. So how we perform free cash flow valuation? So here we did the exercise over 5 years so that it's easy to see on the slides. But the way to go usually to make sure terminal value has not too big an impact on the valuation is to make this exercise over 10 years. So you will realize by the example we will be going over later that over 5 years, I mean, the terminal value has a huge impact on the enterprise value. By doing the exercise over more than 5 years, like over 10 years, so this reduces the impact of the terminal value and the total valuation of the firm. In the presentation that will follow, we will go over an example of how to perform the discounted cash flow.